Hello and welcome. Yesterday, market participants were awaiting the meeting of the Bank of England, anticipating its decision on the future monetary policy. As a result, Bank of England policymakers raised interest rates by 50 basis points, nothing its biggest interest rate hike in 27 years. As expected, this led to a drop in the value of the pound sterling. Indeed, the British economy is sliding into a recession, economic growth is slowing down, and tight labour market is pushing inflation up. Moreover, the bank now expects headline inflation to peak at 13.3% in October and remain at elevated levels throughout March of 2023 before falling its 2% target in 2025. This means that the regulator is unlikely to reverse its policy stance and will continue taking measures to combat rising prices. Obviously, interest rate hikes will gradually ease inflationary pressures, while the UK will still enter a recession. Against this background, the British pound collapsed but then managed to quickly pass some losses. The currency's correction initiated on August the 1st is still in force, but buyers are making every effort to regain control of the price. Today's macroeconomic calendar includes a number of important releases from the United States, such as jobs growth and data on unemployment. Non-farm payrolls are expected to increase only by 250,000 jobs in July after rising by 372,000 in June. Thus, it can be assumed that the overheated labour market will have an adverse effect on the US dollar. In this case, both the euro and the pound sterling may gain value at the end of the week. The unemployment rate is anticipated to remain steady at 3.6% in July. In addition, the US is set to report data on average hourly earnings. The July indicator is forecast to rise at a slower pace than a month earlier. Also, traders may take notice of statistics on industrial production from Germany and Italy. However, these indicators will hardly have a severe impact on the euro's dynamics. From a technical point of view, the 1-hour chart shows that the euro-dollar pair is still trading in a sideways range limited by the levels of 1.0124 and 1.0292. Moreover, the euro is likely to remain range-bound even following US jobs data. Thus, I recommend focusing on the nearest levels. A false breakout at 1.0253 will create a sell signal. In this case, bears will have a chance of dragging the euro down to 1.0220. If the price fixes below this mark and tested from the bottom up, another sell signal will be generated. Thus, the European currency will slide to 1.0187 and probably 1.0158 after the release of statistics on US jobs growth. At the level of 1.0158, it will be possible to go long with a view to catching an intraday correction of 30-35 pips. Long positions at 1.0220 and 1.0187 can be considered only amid a false breakout. In the event of subdued trading activity at 1.0253, the price will be able to break above this level and test it from the top down. In this situation, the volume of long positions will increase, thus pushing the euro up to 1.0292. Short positions will be relevant amid a false breakout at this level. Alternatively, in case of downbeat data on non-farm payrolls, traders may go short at 1.0323 and 1.0374 on the rebound, counting on an intraday correction of 30-35 pips. Meanwhile, the British pound continues to trade downwards, hitting local lows. It can be seen from the trading chart that the pound-dollar pair got stuck in a tight sideways channel. A false breakout at 1.2160 will create a sell signal, thus bringing the price down to the level of 1.2112. If the price breaks below this mark and tests it from the bottom up, the volume of short positions will increase further. In this case, the pound sterling will most likely drop to 1.2068, 1.2031 and 1.2001. At the levels of 1.2031 and 1.2001, I recommend going long on rebound with a view to catching an intraday correction of 25-30 pips. Long positions at 1.2068 and 1.2112 can be opened only in a case of a false breakout. If bulls are able to return the price to 1.2160, the pair will hem into the range of 1.2068 and 1.2211. Therefore, going short amid a false breakout will be relevant only at 1.2211. Short positions on the rebound can be considered at the levels of 1.2250 and 1.2291. Best of luck and have a nice weekend.